Hey everyone, welcome back. Today we're looking at how the Australian share market closed, and the big picture is that the ASX 200 ended the session clearly weaker after a sharp intraday sell-off. The day started with a modestly higher open, but the index quickly reversed and spent most of the session under pressure, forming a solid red candle on the chart. The main driver behind the weaker tone was global risk sentiment. Geopolitical tensions in the Middle East flared again, with fresh escalations hitting energy infrastructure and adding to volatility across global markets. That spilled into equities, with Wall Street coming under pressure overnight, which set a negative tone for the ASX this morning. The local market basically followed that risk-off script, with selling accelerating through the afternoon session. What drove the materials sector decline today? The materials sector was one of the weakest pockets of the index, and the broader sell-off in global growth and commodity-linked assets hit miners particularly hard. Global signals on demand and trade are still fragile, and any spike in uncertainty tends to push investors away from cyclical resources and towards safer or more defensive parts of the market. That's exactly what played out today. As risk sentiment soured, the market treated materials as a risk-on area to trim, and the sector dragged the broader index lower. Why did energy stocks gain amid the market drop? At the same time, energy stocks were one of the few bright spots. With tensions in the Middle East threatening supply routes and energy infrastructure, traders treated energy names as a hedge rather than a risk. Even as the wider market sold off, several energy-related names pushed higher, with some mid-cap and large-cap plays standing out. In a classic risk-off environment where bonds and some traditional defensives are under pressure, energy can act like a real asset safe haven, which is why investors rotated into the sector even as the index fell. The flare-up in Middle East tensions added another layer of uncertainty to an already fragile global backdrop. The ASX is always sensitive to anything that can move oil, gas, and broader commodity prices, and today's escalation did exactly that. The index not only reacted to global equity pressure, but also to the way the sell-off hit interest rate sensitive and growth-oriented pockets of the market. That combination, geopolitics, energy price risk, and global risk-off, is why the ASX 200 ended the day clearly weaker than where it started. Top-performing ASX stocks today. Despite the broader weakness, there were still standout performers. The strongest names of the session were mostly clustered in the energy sector, with a handful of very liquid energy plays among the top-performing ASX stocks. Several mid-cap energy and resources-related names also made a strong showing, catching buying interest as investors looked for ways to play volatile oil and gas markets. A few smaller cap plays in the energy and industrial space also featured in the top-performing list, showing that selective pockets of the market were still catching money even in a down day. If you look at breadth and participation, the day was more of a broad-based sell-off than a narrow move session. The index closed deeper in the red than where it opened, and most of the heavier weight names were dragged lower along with the broader market. There were a few pockets of buying, particularly in selective energy and some smaller cap resources names, but overall it was a day where sellers dominated across the board. From a trading flow perspective, volume picked up in the afternoon as the decline accelerated, which suggests that intraday traders and institutions were adding to short positions or cutting long exposure rather than stepping in to buy the dip. The index also failed to reclaim its key longer-term moving averages, leaving the technical structure biased to the downside for now. That's a signal many algorithmic and trend-following systems are watching closely. So where does this leave us going forward? The ASX 200 is now clearly in a corrective phase after its recent rally, with sentiment weighed down by global geopolitics and a more hawkish-leaning interest rate backdrop. If tensions ease and global markets stabilize, we could see some relief rally attempts, but until the index shows a clean reclaim of its key averages, the bias will likely stay cautious. For traders, that means tighter risk management, watching for exhaustion in the sell-off, and keeping a close eye on energy and commodities as potential leading indicators. And for longer-term investors, today's move is another reminder that pullbacks are still very much part of the script, even in a structurally uptrending market. If you found this breakdown helpful, make sure to hit the like button, subscribe, and drop a comment with whether you're treating today as a sell-off to buy opportunity or a signal to stand back and wait for more clarity. Until next time, stay sharp and keep your risk under control.
Disclaimer: the information contained in this publication is general in nature and has been prepared without taking into account your objectives, financial situation, or needs. It is provided by Titan Securities, holder of Australian Financial Services, license number 307040. It is not intended to constitute personal financial advice. Investing and trading involve risk, and past performance is not a reliable indicator of future performance. You should consider your own objectives, financial situation, and needs before acting on any information contained herein. You should also read our financial services guide and, where relevant, the product disclosure statement and target market determination issued by the product provider. These documents are available upon request. Titan Securities accepts no liability for any loss or damage arising from reliance on this information.